again to the Real Collective podcast. I'm Brendan McKeigan. With me, as always, is Sean Tasse. And if you're having a good time with the Real Collective podcast, please like, subscribe, and share the channel, both on YouTube, Apple Podcasts, and Spotify. We'd really appreciate that. We're going to go over a lot of things, and we do have a special guest. We have the COO of Remax Hallmark. We have, he's been gracious enough to share his time with us. Steve Tabrizi is here. Steve, thanks for doing this.
Thank you very much. Appreciate it for inviting me to your podcast. I've watched your podcast, listened to your podcast since its inception, and kudos to you guys. Have done a great job, and I hope your audience and subscription rate goes up and people start liking you more and sharing you more, because you definitely bring a tremendous value of information to the consumers, which is desperately needed in today's market.
Absolutely. Yeah. That hits on what we're going to kind of touch in today. And Sean, why don't you take that away? I know you had some questions to go into it.
Well, yeah, absolutely. I think the more we have, the less it's me and Brendan talking, and the more we have valued guests like you, Steve, sharing your information, the more value we're going to be bringing to consumers. So what I wanted to sort of unpack with you is you did a deep dive for the entire company. Was it last week or 2 weeks ago? And I know that you compiled a lot of information, and we've been really clearly delineating on this podcast and through different media channels that, hey, here's what we think were some of the reasons that the market shifted as much as it did in 2022, and we didn't really get into the reasons so much as what did happen, and here's what we expect is going to happen in 2023. And all of those are based on things that we hear other people say, things that we hear you say, things that you hear other people say, things that the mortgage brokers say. All of those are based on pulling information from a bunch of different places. So we wanted you to be one of the places that we can pull the information from and share it directly with the people who are watching. Maybe in the first section, we'll talk about what happened in 2022 and why. And then in the second half, we'll talk about what we think is going to happen in 2023 and, more importantly, why. So it's the why episode. It's the last... When I was a kid, I always used to say, I asked why all the time. And I got to a point where my dad was so frustrated with me asking why all the time that his one line comeback would always be, Zed, I win. It's over. Stop asking. so why?
So, hey, I used to tell my kids too, because every time they did anything, they'd say, why this, why that? And at some point I get your dad's frustration. And I used to end up saying, there is no why, that's the way it is. So it's a really good question. I'm glad that you really are focusing this episode on why, because I think that's the fundamental reason that everybody, from economists to the real estate practitioner to the mortgage system, they have really missed to focus and talk about it. So there is multiple why the 2021 and early 2022 was crazy. Why 2022 we had a shift or correction of the market. So I would like to go back the first part of the question that you said, why 2022? But I would like to tie it to 2021 first, because then you will really get the why. We have created sort of a perception in the mind of the consumers. And in our industry, we deal with two people, buyer or seller. We have created this perception that what was offered to us from 2020 to first quarter of the 2022 was the normal market. Everybody got to this idea, my mortgage rate got to be 2%. My mortgage rate got to be 1.8. My variable rate got to be 1.2. So the why starts from there. What happened in 2020 and 2021? The government created an artificial, robust economy because the government has only faced two questions. Question at the beginning of the pandemic: do we help the economy, or we just let it continue its normal course? Obviously, from the historical stats and from the past drastic economic impact, which there was nothing similar to COVID, that it was a global scale, they realized, and the best example was 2008, 2009 crash of the US. The history has taught that the US could have do a bailout a lot faster and didn't have to drag the recession for 5 or 6 years. It went from 2008 to almost beginning of the 13. So they did a good job. They printed money, they lowered the interest rate, and they motivated the consumers go on a shopping rampage. But the consumers, they forgot about that, why they have that ability to go for that shopping rampage, because the money was cheap. So that was the why. And then what happened with that why, the first why, that we had that ability to go crazy, we end up bringing a segment of the demand which we had in our market, and they were sleeping demand. They were sleeping cell group of the people. They couldn't afford to be in a housing market. Suddenly they woke up in early 2020. They said, oh my God, look at the mortgage rate. I can afford to pay a mortgage payment, because the payment dropped. And the early adopter that bought in 2020, they were the biggest winner, to my opinion. And then late 2021, mid 2021 to the early 2022. So it's very simple. I like to always use this analogy, which I have developed in the last few weeks, doing a lot of talk. I refer it to a Black Friday shopping or Boxing Day. We go on a Boxing Day Canadian, we see a TV on sale and it's a good deal. We don't need TV at home, but we just buy the damn TV because it's a good deal. So this is what happened to us in housing market. Interest rate low, money cheap, qualification fast, and then buyers are storming to the market. And then the sellers suddenly, they said, hold on a second. What the hell is going on? I got 10 people want to buy my TV. I got 10 people want to buy my house. So the prices start to climb. That's the why. Nobody paid attention. And the why has caused this fake perception of the entitlement. We think that's a normal market. No, it's not a normal market. Fast forward, come 2022, the government made one mistake. It was great that they did stimulus packages. It was great that they support the economy. They could have stopped it earlier. They could have, because literally by, I would say, mid 21, before the madness, where the madness of the real estate started, the third quarter of the 21 to the first quarter of the 2022, that's 6 months. We were going like this on the prices, and then suddenly we went on a 90-degree trajectory all the way upwards. That was the indicator. The government unemployment was decent at that time, was sitting at about 7. Yes, hospitalities and small businesses, they were hurting because they just reopened in October of 2021, no problem. But they should have scaled down on a general stimulus package. They should have adopted to certain categories, certain sector. No one also can here say, okay, let's blame them. But that 6 to 9 months additional stimulus package really created the madness. Government should have really, from October of the 2021, basically says, okay, let's cut it off.
It seems like there's two different levers, and both levers should have moved at the same time instead of first moving one and then moving the other. Is that right?
Yeah, so, exactly. All the indicator of the healthy economy was there. Unemployment was dropping. People, the consumer spending was increasing. The inflation in October of the 2021 was sitting at about 5.5%, rather than goes all the way to the February of the 2022 at 8.1. So the both levers should have done at the same time.
You know what's really weird about that is I would expect and this is going to get political just a little bit, I would expect a liberal government to make that move both at the same time. I would expect a conservative government to say, no, not too quickly. First, we're going to do one, and then we're going to do the other. From a philosophical point of view, from like a political point of view, not to say what's better or what's worse, but I imagine that liberal government's like, okay, we're doing a thing, go do it. And conservative governments are more like, okay, well, first one and then the next. So it's interesting that.
Well, no, I'm glad that you drag it to the political. What happened in June to the October of the 2021 elections, both provincial and federal?
Yeah.
And guess what? They said, no, federal. They said, don't touch the money. We need their vote.
Yeah.
Province also says, oh, we are in a deep trouble, staffing issues, services. We need the money keeps coming to us. So both parties, literally in the province of Ontario, they drag that stimulus agenda for additional 9 months.
Yeah,
which if they were a true caring economical politician looking after the inflation, the both parties should have said, look, irrelevant of the election, we have done a good job. Both parties are sailing through this storm. So let's just make the responsible decision.
Yeah, but during an election time period, it's no sudden movements, right? It's just keep it the same. Don't change anything. Keep it the same. If it ain't broke, don't fix it. So that's
exactly. So that was the why.
Okay,
so you got the why done.
Good, perfect. So that's the why on the way up and leading up to the beginning of 2022, and I want to get into that in a second. But before I do, you made a comment about the market crash in 2008, 2009. We've had a lot of people say, "Oh, well, I'm waiting for the market to crash here in Canada." We all know that it's not going to, and the reason it's not going to is because they've increased they've added qualification rates, which they didn't have before the market crash in 2008, 2009. Is there any other reason why we should not be expecting, the sky is falling, a crazy market crash in Canada?
The only reason that is not, first of all, the terminology of the crash. A crash happens when the major fundamental of the economy, which is the number one, is the employment sector, goes through the roof. Second is basically the massive of the people are also drop their spending habit, the normal spending habit. Third, related to our industry, people like 208, they just go drop the keys at the bank. It says all yours, because they didn't have no equity in their homes. People are doing a wrong comparison. The wrong comparison is basically, why would you compare it to 208? Because in 208, American, they had not even a 5% equity in their home. They had this ninja program from 05 to 08 that the people were getting qualified for 100% of the mortgage. So psychologically, just think about it. If you and I and Brendan, we have now 100% mortgage, and tomorrow we have a financial burden, you and I were going to say, what I'm going to lose? Nothing. Like, here we go, CIBC, TD, or whatever it is, to take my house. I don't have no equity. Am I attached to the brick and mortar? No. Canadian, they have great asset and equity in their home historically. 50% of the mortgage homeowners in Canada are debt-free, no mortgage. The other 50%, they have anywhere from the lowest of the 20% equity to 40 to 50% equity. So it's not going to happen. So, right. So the only area that we have to worry now, the rise of the interest rate will cause the business sector, doesn't matter what type of business sector it is, could be small, could be medium class, could be large, really pause on expansion and infrastructure and the growth. When you pause on expansion and infrastructure and growth, when your company's sales activity drops, then you start shaving from the top. And one of the shaving from the top, what happened? Lack of investment, no rehiring. So that could, for a short period of the time, really hurt us and basically bump the unemployment rate maybe to about 6.5 points. Still is a good rate in Canada. but I don't think so. We will have maybe a drag on a slow economy. But if we ever are thinking that the housing, Remax Hallmark moved to Ottawa in 2016. I vividly remember the average price when we moved into Ottawa was around $500,000 across all the time.
Less.
Yeah. Well, let's call it 500, and right now it's sitting at 800. Let's say you're right, 400 now sitting at 800. Yeah. If consumers are thinking that the Ottawa housing market is going to go back to 2016, I'm going to be very drastic. They're dreaming. They are absolutely dreaming. So what's going to happen? I'm going to go from 800 to 750, 7.25. But if you scale that $300,000 growth from 400 to 700 over the last 6 years, you tell me what's the percentage of the growth. It's a healthy market. That's another why. It's 20% digital growth, double-digit growth, year after year from 20 to 21 to 2022. Is it a normal and healthy market? No. So this perception in the mind of the sellers, I'm entitled to get that $1 million for my townhouse in Ottawa, in Toronto, $1.4 million for my townhouse, in Barrie, $900,000. Please wake up. It was fake. It was fake. Yes, some people cashed out. Kudos to them. It's called opportunity in any market. It's like a stock market. The stock market goes through the roof. You are not emotional. You said, let's cash out. And then the next morning you wake up, the same stock that you cashed out the night before, now 30, 40% down. So it's just a matter of a timing.
So you said earlier, an artificial robust economy. So shifting gears into sort of the second half of 2022, why? And I'm drawing a really easy parallel between the change in interest rates and the change in house prices. That's the easiest parallel. There's an inverse relationship between the two because the consumer, especially in Ottawa, is a payment-based consumer. So correct. Why else? And if there's something else to add on to it, why else did the prices drop? A residential average price point drop from March in 2022 of 800,000 down to December of 2022 of 600,000. Well, that's a 25% drop. Other than the rates, what else changed during that time? What's the other why?
So, consumers' behavior that changed. Consumers' behavior. Any shift of the market, don't look at the pro investors. Don't look at the seasoned veteran real estate investor that they've been through the game of the recession, change of the market. And we have maybe a 1% of the audience of the real estate are in that category. 70% of our audience are, as you said, as consumers, day-to-day job, fixed income, couple, single, and now they suddenly wake up in, let's call it May of the 2022, after a couple of increase of the rate, and they're saying, hold on a second, the prices are dropping. They're confused. And unfortunately, the information highway in Canada and media, obviously, always like to sort of focus on negativity. I shared in my report, they said, oh my God, the RBC was claiming that at the end of the 2022, the wealth of the Canadian in housing sector from $1 trillion and so on, so dropped to billion and so on. So, but even their own chart still is in a positive territory. But nobody talks or dive deep on this. We had in Ontario an average growth of from 2021 to early 2022, we had an average growth of the 25 to 47% in increase of the prices. Your example right now, from 800 to 650, now it's a drop of, let's call it 15%, 20% in the prices. So if you call it the average of the 30% across Ontario increases, so you take the 20 out, we are still in a positive of 10%. So the only thing changed in the last 3 quarters of the 2022, the habit and behavior of the consumers. The consumers, the buyers are saying, okay, let me wait. The market is going to crash. The sellers are saying, no, we'll ride it. But one thing people didn't pay attention in 2022 about that behavior, which was a good behavior from an inventory standpoint of the seller. If we had a unsustainable, weak market and mortgage holder, which are the sellers and homeowners, why the market wasn't flooded with the inventory, even with the increase of the rate.
Now,
It wasn't.
The problem was the inventory was so low before that it felt like it was flooded with inventory, but the reality of the situation is it's still only 40% of what we were seeing in terms of inventory in Ottawa back in 2015. So in 2015, we saw 10,000 properties for sale. At the peak of the market in 2022, when we had as many properties for sale, it was 4,000. But we were used to seeing 1,500, right? So people have a very short memory. So
yeah, so that 1,500 also, again,
it's fake.
People have to. It was an unprecedented environment and the condition of the market. Consumers, they have to come to this realization. To 2023 is a year of realization. What is the historical 10 years trend of a real estate market? Yes, we had a couple of trajectory upward. We had a couple of trajectory downward, short period of time, flattening, and it's the indicator are all there. The behavior of the 2022, by November of the 2022, we notice the month over month sales are actually increasing, not decreasing. Guess what? The consumers are saying, okay, this is it. This is the new reality. Acceptance. I call it acceptance. The sellers are still upset. The sellers are upset. The sellers some of them are saying, no, I'll rather wait. The only group that unfortunately caught in this middle, buyers that were smart. Buyers, majority of them, the report shows, they actually, because the end user buyer, the Ottawa characteristic buyers, they locked in for a nice 5 years rate, 1.8, averages of 1.8 for 5 years. Sean is one of them. Kudos. Bravo. He's not worried about it for the next 5 years. Sellers, depend what seller you are. Of course, if you bought second half of the 2021 and the first half of 2022, right now you're going to lose mark. I'm sorry. Neither Sean or Brandon or me can do any magic, but this is it. So what's our recommendation? Because the affordability is really a major concern, rent it, have a ride for another 18 months, and then you'll be in a much more better position to sell. Yes, there will be certain sellers, unfortunately, that they need to have this ride for 3 to 5 years in order to come back to the break-even point. But that's a reality of the market.
Well, we'll poke our head back up and see if we see our shadow. And if we see our shadow, then we'll make a decision to sell or to not sell. I think it's a good place to talk about the reasons why we are in the position that we're in. We can wrap that up. And then the second half, we'll talk about some of the expectations for 2023 and why we expect those things. Make sense?
Okay.
Sounds good. We'll take a quick break. We'll come back and wrap things up with that here on the Real Collective podcast. If you do want to talk to Sean or I about anything that you're hearing so far today, book an appointment with us in our Calendly links below. We'll take a quick break. We'll be right back.
This episode of the Real Collective podcast is brought to you by Real Collective. Real Collective brings together best-in-class real estate agents and collective experts in the field to deliver the best possible service to our clients. We govern ourselves with honesty, open-mindedness, and compassion. With diverse skill sets, our agents are able to better serve a wide array of clients, including first-time buyers, first-time sellers, transferees, estate sales, investors, and rural, vacation, and luxury properties. Authenticity and transparency are pillars of our process, which allows us to put our clients at the center of everything we do. Our years of experience and knowledge allow us to deliver prestigious service and optimal results. If you are interested in buying or selling your home, contact us today at realcollective.ca.
Welcome back, everybody. Hope you enjoyed the break and our video there. Don't forget to like, subscribe, and share the channel on YouTube, Apple Podcasts, and Spotify. While we wrap things up here, we're going to do, I don't know if I want to call it a Q&A, but we're going to wrap things up because there's still some more whys. So, Sean, you had some that you wanted to follow up on.
Yeah, I want to get into not necessarily Q&A, but expectations, I guess, for 2023. So we talked about the expectation, or what happened in 2022 and why it happened. Now, what are we thinking is going to happen in 2023, and more importantly, why? So my guess is there's going to be, you said it's a coming to terms with the reality of the situation, an awakening, or sort of the sobering fact of, hey, here's where we are, Steve. So is that going to sort of be the trend for 2023, where we're back to reality? Because I think if we look at the overall graph of growth, especially in Ottawa, and you draw a best fit line, yeah, okay, you've got some crazy high, you've got some crazy low, but your best fit line is probably going to continue to look like 6% per year. So is that what we're expecting? Is this year might be 2 or 3%, or 5 or 6 in terms of growth rate? What about in terms of number of sales? So if we're talking about buyer and seller sentiment, are they going to be able to get onto the same page about the fair market value for their house? So what are we expecting for 2023, and why are we expecting that?
So the biggest question in 2023 is, in Ontario, it will be the question of the affordability and job opportunity. So Ottawa positioned itself quite well. It's affordable compared to Toronto GTA, compared to even cities such as Montreal, which is neighboring city in Quebec. Job sector in Ottawa, because of the civil servant and higher pay on average compared to the Canadian rate, it's great. And then we got a demographic shift of the people. They said millennial, particularly millennial at the stage of they're 38 to 40 years old, that they have no family. And they're saying, look, COVID taught me this. Life is too short. I need to really exercise my home ownership wish. And I can do it in this part of the country. I can do it here. Yes, I will do it in Ottawa. So Ottawa will not, to my opinion, suffer drastically or more than other cities that they may. So number of the transaction would be very much, maybe even slightly higher than 2022, because the acceptance of the both buyer and seller and the same cross line is there. The battle would be the mortgage qualification, but we already have noticed since last few weeks, because of the drop of the bond market, the banks are entertaining more aggressive packages, 5 years rate at 4.95. And we will see by probably fall of the 2023, a real sort of the return to the normal of a 5 years mortgage rate be at 4%, and hopefully start of the first drop of the rate. But we have to accept the rate from a 4.5 is not going to go back to 2. What another most important element in the rate sort of a trajectory of and also adjustment is, yes, from a quarter point, we went to the 4.5. What is supposed to be before COVID was 1.75, which was even low. The actual rate should sit at around 2.25 to 2.5. So we are not up by 4% in a rate. We are only up in a rate by about a 1.5. When are we going to do that drop? When are we going to see that drop? Probably from fall of this year. So I don't see a major issue for Ottawa. I see an issue definitely for qualification. I see also opportunities in this market. Unfortunately, during the madness and issue of the COVID and with the stimulus packages, some consumers, they went on a shopping spree. They really spent more than that, what they should have done. I would see the cottage country will see a massive, more, I shouldn't say the word massive. I would probably say more adjusted on the price. Because if you recall, during the 2 years of the heavy tension of the COVID, the perception, the argument was, yes, I can work from home. I can be on a Zoom. I'm going to go to the cottage country. And the cottage country had a massive spike. They're going to see the adjustment. And we already have noticed in the last 6 months, cottage country has a higher inventory of the listings. And we have also noticed people are coming back. People are coming back. Look at our own office in Ottawa. Bronson office, large facility, hallway were not crowded, the rooms were not crowded, but we can see in the last 90 days, 120 days, people are coming back. Yes, there is definitely a shift of a mindset and work environment for years to come and last, that basically, because of the affordability, we love to go back to our workplaces, but the employers, they have no choice to offer the hybrid model. They have two choices: either accept your demand for increase of the wages, which they can't, unfortunately, because their companies, the cost structure and everything is not feasible, or create a hybrid model that the employees, they basically have some benefit of the less expenses of the commuting, food and everything. And then also the employers then can create the balance. So that's basically rental market went through the roof. It won't have that 15 or 17% of the increase that it had in the last quarter of the 2022, but it will be still close to the double digit in 2023 too, probably 8 or 9%. And we will see also many renters, they are coming to the realization, where is the opportunity for me to own a home rather than paying $2,000, $3,000 for rental, which probably would be a nice re-entry of the game changer for them in a condo market. And that's basically, Ottawa doesn't have a major condo market, so I'm not really worried about the condo market of the Ottawa, pre-construction of the Ottawa. But I can tell you in GTA, it will be the best opportunity for people to invest or re-enter the real estate industry.
You made some good points. I took some notes here. I read an article recently. I'll see if I can find it and we can post it in the notes below. But Ottawa was ranked as the third most affordable capital city in the world. I was on a blog.to article. I also read another article. This was a Remax article that they said there's 3 cities that are likely to remain as sellers markets in 2023. I think it was Halifax, London, and as well as Ottawa. I was interested to see that. But what you're saying is echoing that sentiment. And the third note that I took is that when I spoke with a friend of mine, he was on the show actually, Drew Ross, and he is a top producing broker at Sun Life, and he understands the mechanics of how all of it works. And he says, look, we need to have interest rates between 4 and 6%. This whole thing is built around having a borrowing rate between 4 and 6%. And if it's too high, stuff starts to fall apart. And if it's too low, that's a problem too. So he says the whole thing is built around that, and that's the normal, healthy market. So that's where you should expect to see interest rates being. And that's why I think when the rates were as low as they were qualifying, the banks were qualifying us at, 5.25 or 5.39 or whatever it was, to say like, hey, when we get back there, can you still afford your house, right? So,
yeah, well said. Another element that everybody got to pay attention, the question of the supply demand. As much the politician in 2021, they tried to address it. We had the slew of the policies announced after one in the last 90 days. But it's interesting. Look at the Ottawa's construction starts. It has dropped. I was thinking, I spent the last 4 or 5 weeks during the Christmas holiday in the States. The only way that we can really increase our supply, we don't have the labor force. Immigration is in the maximum capacity, is doing the best they can. But unfortunately, those skilled worker, independent immigrants, talents that they are coming to Canada, there are still red tape in terms of to get adjusted to the society, community, language, learning the trades and everything. Frankly, one solution is left for Canada. Are we ready to bring foreign workers for a short period of the time to only for one sector, for housing sector? I will share something with you which is really interesting in US. Hurricane Ian happened last year in October in the state of Florida. It's like it created trillions of damages. Yeah. It's unbelievable how from other states workers are all here And it still is a 3 years recovery. 3 years recovery. So is Canada ready to do such a move? You know, you want to build homes, you need skilled workers. And
we're not gonna solve this housing affordability crisis unless we build more houses. It's just gonna continue.
You see, we go back to, we should finish it this way. We should go back to the why we are in this mess. How could you have two levels of government with opposite policies? Federal government bringing 500,000 immigrants, provinces are saying, sorry, I can't do the job. I need more people. So you are bringing people, but we can create housing for them. So these two are not talking to each other. So, and we have to accept Canada needs immigration because our birth rate is dropping. If we don't bring the talent, it's not only for construction. We need talent for medical, for technology, for servicing, you name it. We need it in every sector that you can imagine. The only way to help the construction industry is allow them to bring the foreign workers.
And I don't think you can complain about one and the other. You can't complain about both. You choose your side. If you're against foreign workers for whatever reason, then tell you what, they're hiring. Go get the job. You know?
Listen, Brendan, it's impossible. The best year we ever had in Ontario was 100,000 homes. Mr. Ford his own report says 150,000 homes. And now the builders, the cost of the material, the levies, the government fees is gone so up. Many of them are just saying, I'm not building. It's not worth it for me at this stage because the prices has dropped. They are waiting, land banking for the time the price goes up. So when they are not building, are you going to force a private sector to build? No, it's my property. I'm not building.
Yeah. Absolutely. Well, I think that's a lot of whys that we answered for you guys today. So I think that's a good spot to wrap it up. Steve, thank you so much for doing this and sharing all of your very valuable insight with everybody. That's very much appreciated. We're going to wrap things up here on the Real Collective podcast. Again, please like, subscribe, and share the channel on YouTube, Apple Podcasts, Spotify. If you want to talk to us, and our Calendly links are below. And we also have links to other videos that might pertain to this. So if you want to talk about it, Sean and I are both available for you. Steve, got a follow-up question? Was that this one? No, that's just like, we did it, guys. Take a look at it. There's the thing. I like it. Awesome. well, thank you so much, Steve, for doing this. Really appreciate it. I'm Brendan McKeigan. This is Sean Tasse. And until the next one, keep it real.
Collective.